What's going on, guys? It's Expo Jesse. Today I'm going to be covering a very requested video, which is going to be risk management. It's probably the number one thing that separates profitable traders from being profitable and unprofitable. And it's really not that big of a subject in terms of, complexity. It's going to have three foundational principles. And as you can see on the screen, it's already up there. So it's going to be a little bit of a boring video. We're going to start with the spreadsheet, stare at that for a little bit, go over the numbers, and then we'll go into a thinkorswim on demand, which if you don't know what on demand is, it's basically where you can go back in time and simulate, real market conditions with entering certain orders and stuff like that. So we're going to go through that and see how different risk management techniques can be used and the best way I've found for me to protect my capital. So without further ado, let's get into the foundational principles. Three things. You have to know your win rate, you have to know what your risk to reward is, and you have to have consistent risk. For me, that it's very simple. If I don't have consistent risk, right? Let's say one play I full port and I lose 30% of my portfolio in one trade. Okay. Well, then if I go over here and start risking proper risk and go 10% or 5% or what have you, whatever proper risk is to you, it's going to be a personal situation, right? I can't tell you 5% of your portfolio is the best way to risk, right? Risk is solely up to you. You need to see a financial advisor, see how much you can risk. And I'm not that guy. I'm not a financial advisor. I'm just telling you what I've done and how I've learned risk management for myself. So again, back to the scenario, if I full port and lose 30% of my portfolio, and then I start, making 10% of my portfolio for trades, it's going to take me a lot of trades to make up that 30% loss, right? It's going to take a lot of good trades, and it's going to take a lot of profitable trades to make up that big, lack of lapse in judgment or what have you. So you need to have, you need to know what your win rate is. You need to have good a risk to reward, and then you have to have consistent risk. So if you don't know what your win rate is, there are tons of different trade trackers online. I have them myself. It's very simple. Go through your trade history, load it in here, and then see what your win rate is. It's probably not going to be 83.66% when you first start, but over time, when you put those losers into a spreadsheet, it feels differently than just losing and then going on with your day, right? If you have to hold yourself accountable, you're going to think differently when you take risky trades or trades that might be out of your system, and you might, say, I don't really want to put that in the spreadsheet later if it's going to be a loser. It doesn't really line up with my system. It's going to make you think differently. So if you don't have a trade tracker, you need to track your trades. And outside of that, it's the only way to know if you're profitable or not. You need to know your statistics, right? If you play basketball and you have no idea what your field goal percentage is from the 3-point line, then you don't know if that's going to be a strength of yours or not. So, and you don't know if it's something you need to improve on. And so by tracking your trades, you're going to have the statistics and the data to back up what you need to do differently and how you can improve. So you need to know what your win rate is. Second thing is you need to know what your risk to reward is, your average winner compared to your average loser. So for futures, you have a set amount of risk, so you lose 100% of what you risk. It's not like options where if you have a 100% loser, you lost 100%. It kind of is, but it's a little different. So futures, I have a 2.85 risk to reward. Options, I have about a 1.5 risk to reward, maybe a little higher than that. So I know that my average winner is higher than my average loser. And the only thing that's going to hold me back is if I go heavier into trades that lose. Okay. So I have an 83% win rate. I know my risk to reward is solid, 1.5 or above. Really, you can have a 1 risk to reward. And as long as you're winning more than 50% of the time, you're going to be profitable. Unless you don't adhere to number 3. Number 3 is consistent risk. So again, back to that example, if I full port and lose 30%, it's going to take me a lot of trades to come out of that hole. Okay, so we're going to go through a couple examples here on the spreadsheet, then we're going to jump into thinkorswim's on demand feature. So the first one we're going to figure out is consistent risk or a high win rate, but having your losers be bigger than your winners. So let's say you have an 80% win rate, but your winner or your losers are 3 times bigger than your winners. I'm trying to multitask here. So you win 8 times out of 10 and a fantastic win rate. But when it comes down to it, you're taking profit at 10%, but you're letting your losers run. Let's say these are 40%. You have a big win rate. You have consistent risk because this little side tangent over here on the right half of the screen is just multiplying your percent return times your risk of your portfolio. So you have consistent risk. So what are you missing? Number 2, risk to reward. So let's even that out. Let's say you have a 40% win rate. Oops. Okay, and look how the numbers change. So that's just a 1-1 risk to reward. Now, let's say that you go and you go on a losing streak, right? But at least you have a good risk to reward. Well, you have to have higher than a 50% win rate to win in this market, no matter what. So let's say you have a 50% win rate. Well, you're just under break even on a pretty, 25% of your port's pretty tough. So 10% and 5%, you're pretty much break even, which is fine because your win rate is break even and your risk to reward is break even. So you should be break even. If you have consistent risk, if you have good risk to reward, and you know your win rate is above 50%, then risk management should not be a factor. These are the 3 foundational principles. I get a lot of DMs about it. There's a lot of people who have high risk to reward, or they have a high win rate. They tell me they won 9 trades out of 10, but then that 10th loser blew their account because they full ported. It's very easy to get tunnel visioned and see, if I full port this and make 40%, then now I'm up on this port. That's $1,000 port. I'm up $400. Well, the flip side is if you lose 40%, you're down $400. So gotta have that in mind, and you gotta think about the numbers, right? So if I again go back to just an 80% win rate, let's say I lose 5 trades, but then the next trades I go on a 15 win streak. Well, I know that in the long run I'm going to make money. That's what matters. So it's really not that long a video. We're 7 minutes in, and we've covered pretty much all the principles of risk management. But let's go into on demand here, and we're going to go to a random date. Let's go to January, and I'm going to skip to the end of the day here just to show you guys how to use this. Get a little side tangent here. But we're going to look at 2 trades. One we're going to over leverage, and one we're going to have, less leverage or normal leverage. So we're going to go about 3 times as heavy into the loser than we will the winner, and see how that affects your P&L. So I know that this day kind of went down. I'll take a look at SPY here, and this is kind of how I backtest and how you can look at different risk management techniques, or this is how I learned the best way to manage my long-term portfolio and stuff like that. So I know that overall everything went down. So I'll go back down here to 10 o'clock and buffer that out. Then I'm going to go to the Qs, or let's do blue chips all over. So I'm going to go and buy some Apple calls out of the money. I go about 1 strike, and I'm going to buy, let's go 25 contracts here. Okay. So about 25 contracts of Apple, a call I know they're going to lose because everything went down. Then let's go to Disney. Okay, so I'm going to go about the same way, same one. I'm going to go about a little under $1, but I'm going to go 5. Okay. And this is real life stuff. Okay, this is staged because I'm, doing it knowing what the outcome is. But this is real life stuff. Sometimes you over leverage, sometimes you dollar cost average, which it is, it's not the end of the world. But at the end of the day, if I'm risking more on my losers than I am my winners, it's going to be tough to be profitable. So I'm going to go 5 trades deep here. Let's go Tesla. Tesla's probably a bad example. Let's go NVIDIA and AMD. And I'm going to load up 5 contracts again of 1, and then let it go. And that'll be a 75% win rate, actually. So we'll stop at 4 trades. And sometimes it buffers here. Just let this go for a second. So 5 contracts here. I know that 5 out of these 4 trades, 3 of them are going to be winners. So let's go over here to 3 o'clock again. You can ignore that SPY and SPX, and it's not shown down here for some reason. But we see that I went heavy into the, okay, we have 4 plays, 3 were winners, right? I went heavy into the loser. I have 15 contracts on the board for winners, 25 on my losers. Well, my losers down 60%. I have 2 trades that are above that in terms of risk to reward, and 1 trade that's below. So I would say my average winner here 90, 90, and 30. Quick math, probably about 60%. And then my loser 60%, but I went heavier on my loser. Right, I had the 3 principles. Remember, win rate. Okay, 75% win rate, 3 out of 4 trades. Risk to reward, 60% loss, 60% winners. Good risk to reward. Why am I not profitable? Well, $400 plus 400 plus 100, so $900 in the green. But I went heavy on my loser. I'm $1,300 down, right? So I'm net negative. It's really that simple. You adhere to the 3 principles. You know what your risk to reward is. You know what your win rate is. You have consistent risk. It's risk management. Okay, that's all. It's all it is. Like I said, I'm not a financial advisor, so do your own research. Figure out what your risk management is, but this is what's worked for me. So hope you guys enjoyed. Hope it helped. A little 12-minute video here on risk to reward, risk management. And I'll see you guys on the next one. Peace.